So we are recording now. So it's a pleasure to have Christian Montes presenting
Recording in progress.
the paper, the anatomy of machine learning based portfolio. Oh, so Christian, you have about 50 minutes. Then we can have questions. So the floor or the Zoom is yours. Yeah.
Thank you. Yeah, so as Marcelo said, the title of this paper is The Anatomy of Machine Learning-Based Portfolio Performance. This is joint work with Philippe at the UQAM in Canada, Dave, who's at the Fed of Atlanta, and Sander, who's at Aarhus University. And obviously, since we have a person from the Fed, there is like the usual disclaimer that, we're not speaking for the Fed, but only for the authors of the paper. So probably as you guessed from the title, this is going to be about portfolio returns, and asset return predictability is basically a leading topic in empirical asset pricing, and usually now out of sample tests are routinely employed. I mean, this has been the case for a while now, since you never know if your model is overfitting, but this is particularly important in an era of big data, right? I think doing any of this analysis with machine learning models and lots of variables, I mean, you will be able to fit returns quite well, but that does not really speak for any out of sample performance. And in addition to statistical accuracy, which is often, in this case, measured by, for example, out of sample R squared, it's now routine to analyze the economic value of return predictability via an asset allocation exercise. So returns forecast based on a large set of predictors serve as inputs to construct a portfolio, and portfolio performance metrics are then evaluated over some evaluation periods. And usually these are compared to a benchmark portfolio, right? To measure the economic value of return predictability done by your model. There's a spate of recent studies that use a multitude of firm characteristics and machine learning methods to forecast the cross-section of out-of-sample stock returns. And the usual way it goes is that you predict basically the cross-section of stocks, then you sort these predictions, and you go long the stocks with the highest returns and short the stocks with the shortest returns. So thereby you're constructing a long-short portfolio, and these are shown to provide substantive economic value to investors. So in essence, this is strong evidence of cross-sectional return predictability. However, the issue is that the literature does not provide a general methodology for measuring how each individual predictor on the model or groups of predictors contribute to this economic value, right? However, you are measuring economic value, because there's obviously many ways to do this. So we fill this gap in the literature by developing a method based on this idea from Shapley game theory back in 1953 to directly estimate the contributions of individual or groups of predictors for portfolio performance. So we essentially decompose the performance in terms of the underlying predictors that are inputs to the model. And thereby we say we anatomize the economic value. So the logic of Shapley values is to essentially fairly allocate the contributions of predictors in a fitted prediction model with respect to portfolio performance. So a contribution is essentially to develop a new measure, which we call the Shapley-based portfolio performance contribution, so the SPPC, for predictor P, so therefore subscript P. And this can be viewed as an ML model interpretation tool for finance to essentially peek inside the black box and understand the roles of individual or groups of predictors in determining the economic value of this return predictability. So we start by extending the conventional Shapley values to estimate the out-of-sample return forecast From then we went on to essentially looking at the contributions of each predictor to portfolio return, and from portfolio return then to any portfolio performance metric, right? And that is essentially what gives rise to the SPPC. So this measure is very flexible, it's model agnostic. I mean, it can be used for any prediction model, also for an OLS regression. And you could say, well, you know, for an OLS regression, that's almost trivial, right? Because, you know,
can I ask you a question?
Yes, of course.
One question is like, how do you measure, like, how do you compare Sharpe ratio versus Shapley value?
So we will get to that, but this is not essentially what we are. I mean, what we're gonna be doing is that we will be decomposing the Sharpe ratio in terms of the individual predictors of the model. So we will tell you how much of the Sharpe ratio can be attributed to each of the predictors of the model.
Okay.
Does that make sense?
Sure.
So again, you know, going back to the OLS model. So imagine if you have an OLS model. I mean, intuitively, you could think, well, you know, let's suppose that you have 3 predictors, and then, you know, you have a Sharpe ratio of 1, you know, which is a reasonable Sharpe ratio. And then you could think, well, I can just, you know, essentially set score my predictors such that they are, you know, essentially standardized. And then you can look at the largest, you know, slope coefficient for that predictor. And then, you know, if that slope coefficient is 3 times larger than the other 2, then you might conclude that, you know, that predictor is contributing, you know, 3 times as much to the Sharpe ratio as the other 2. But I mean, this is essentially what we show in another paper. You know, I forgot to mention that this is a spin-off of another paper where decomposing the out-of-sample loss of forecasts. That just because a model is giving a large weight to a given predictor, that does not necessarily mean that that larger weight translates into out-of-sample, you know, contribution, because you might be overfitting, right? So Shapley values in the context of, for example, an OLS model, they essentially just end up being the slope coefficient, or slope coefficients is their local multiplied by, you know, by X, by the predictor, by the d-mean predictor, if we want to be like exact. But my point is that even for a simple model such as OLS, it's not trivial to decompose out-of-sample performance, right? And what we're doing here is we're providing a tool that does it for any, you know, simple or complex model, so it can do it for any model, as long as, you know, this model is only a function of, you know, a set of predictors, right? It can be used for any strategy that maps returns forecast to portfolio weight. So, you know, one case, you know, as you asked, Mehmet, was, you know, the Sharpe ratio, but it could also be, I don't know, the Kalmar ratio or alpha, you know, in terms of, you know, the Fama-French, you know, 6-factor model. So any portfolio metric that you want, that is a function, obviously, of your, you know, ML forecast, right? But, you know, this will be the case since you're using an ML model to compute. So it's very flexible. And again, it can be computed, yeah, for any performance metrics. So we illustrate how to use the HPPC in an extensive empirical application. We will be generating monthly forecast of individual stocks returns using these 207 firm characteristics from Chem and Sinoran. And we will be using the XGBoost algorithm of Chen and Gestring. We also use other algorithms, you know, they're relegated to the appendix. We like to focus on XGBoost because it's the best performing model, right? And gradient boosted trees are, you know, just, it's such a strong algorithm that, you know, for this type of data, they usually dominate other algorithms. So we sort stocks into quintiles based on XGBoost. And then we go long the, you know, sort of like the top quintile, and short the, you know, the bottom quintile. And each leg is evaluated. So we do something slightly different than the literature, because normally what the literature has done in the past is that they use a regression model, and then they go, you know, the top predictions and short the bottom predictions. But, you know, when you think about it, this is essentially a classification problem, right? A multi-class classification problem. So we treat it as such. In the appendix, we also use a regression, you know, regression-based versions of the models that we have. And the classification model is just doing much better. So, you know, this is sort of like yeah.
Can I ask you a question? Did you try something else too? Because the long-short portfolio kind of thinks that, I mean, if there is structural instability if the bad stocks can behave super well in the another term, then keeping them makes sense actually.
So this
like,
goes
did
a
you try
little.
any other portfolio other than long short?
We do long short because this is sort of like very standard in the literature.
Yeah,
But as,
no, what I'm telling is like long short plus something else too. Like long short is good, but did you try something else too?
No, what we do is that we decompose performance also of the long leg and of the short leg. So we can, for example, like the alpha, we can tell you how much of the contribution is coming from the long leg and the short leg, which
Okay.
sort of relates to your question, right? That, I
Yeah,
mean, it
yeah,
might be that everything is coming from the long leg or the short leg.
yeah.
As we will see, results are a little bit, surprising somehow because, there's a large part that is coming from the short leg for some characteristics. So that's that was interesting. We get, really impressive Sharpe ratio of 1.8 and large alphas. So the first time we saw this result, we thought, okay, we need to double check that there is not any, forward-looking bias. There isn't, but as I will show later, most of this, sort of like almost incredible performance comes from the beginning of the sample. And then in the later part of the sample, we're still beating the benchmark, but not nearly by as much. And again, this is sort of consistent with what you see, with other papers using, ML models to predict the cross section of stocks. We then place individual firm characteristics. Since we have 207, it will be too computationally intensive to do it for all of them. So we group them into groups. That helps, with the fact that, we're interpreting it, but also, these groups of predictors are usually correlated, right? We can also do it for each individual predictor and then add them, because that's a nice thing about Shapley values, that they are additive. But I mean, this project, computationally took several months running on like around 500 cores. So, it would take years to complete if we went that way. So Shapley values exploit the analogy between players in a cooperative game earning a payoff and predictors in a prediction model, right? So you want to fairly allocate the payoffs to the players in a game. And again, if you think about a football game, I don't know, you think about, Messi or, I don't know, your favorite football player playing in a game, and let's suppose, it's Argentina or versus, I'm not gonna say Brazil, but, I could say that since Marcelo is here. But, let's suppose that that Argentina, it's Argentina and Mexico. Argentina wins 3-0, right? And then you want to be able to allocate those 3 goals to each of the players and assume that you're interested in Messi. So how would you do that? I mean, how much of those 3 goals are his, right? And you can say, well, he scored the goals, yeah, but I mean, the payoff of that game actually depends on all the other players, right? So if you really wanted to see, his contribution to the payoff, then you would need to look at all the different coalitions, all the different subsets, with and without Messi, and basically rerun the game, right? And then see, okay, what is the payoff? And the reason why that is not trivial is because, well, Messi, there are interaction effects, right? Messi might be better at, scoring when he plays with other particular team members. But also other particular team members might have the same set of skills, right? So, essentially correlated predictors. And again, this is what Shapley showed, right? That if you, look at all the coalitions with and without Messi, you will essentially be able to extract his marginal contribution. In the Stromberg and Kononenko and Lumberg and Lee show how Shapley values can be used to allocate the contributions of the predictors to a model prediction. And we essentially adapt the algorithm of Stromberg and Kononenko to a panel setting where the model generates individual stock return predictions based on a set of firm characteristics. So a little bit of notation. The paper is a bit heavy on notation. The slide's not that bad, but the paper is a bit heavy. So the index, we index a set of predictors by S, and that goes from 1 to P. The index of cross-sectional units by I. The index set of cross-sectional units by C. The P vector of predictors for stock I in period T by XIT, as usual in a panel setting. The returns by RIT. The prediction model, again, F of XIT plus an error term, and then the fitted model is just F hat. Then the window of panel data observations used to train the model, but W subscript j, and that goes from tj start to tj n minus 1. And then the fitted prediction function evaluated at instance xit, trained using window wj by this expression, right? And again, this is important since Shapley values are local, right? They are able to decompose each of the predictions made by the model, right? So again, Shapley values measure the marginal contribution of predictor xp, for instance I, at time point t. And this is generally the form in which Shapley values are shown, right? So the Shapley value for predictor p, for sets of for the sort of like group of predictors x at t and the window wj in this case will be given by the weighted sum of the marginal contributions of the predictions of the model with for all coalitions that include and exclude predictor p. And there is this weighting function here because, well, you need to count how many times you will essentially have equal coalitions. So if you think about, coalition 1, 2, with predictors 1, 2, and 3, and you want to estimate the marginal contribution of predictor 3, well, you will have coalition 1 and 2, and then predictors 1 and 2, and then you add predictor 3. But you will also have 2 and 1, and then add predictor 3, and those are equivalent, right? So you essentially just need to take care of that, and this is what this weighted sum is doing. And again, you're just looking at all the different subsets of predictors, including and excluding predictor p, and taking a weighted average of that. So a really nice thing about Shapley values is that they have this local accuracy property. So essentially, you can decompose the prediction of the model in deviations from the prediction.
Can I ask another question? Sorry.
Yeah.
How
Yes,
do you
of
like,
course.
if the P's are large, how do you solve the computational issue?
Yeah, so this is what we're gonna get down to after.
Okay, thank you.
I mean, this is it's essentially the whole but I mean, this comes from computer science, right? But it's gonna be sort of like a sampling-based approach. So the prediction, so you will be able to decompose the prediction of a model in terms of deviations from the empty coalition. So the model, just running on a constant, which again, for most regression models, this boils down to just y bar, right? It just ends up being the in-sample mean. And what for classification models, it just ends up being, the most common class, right? But you can decompose this prediction in deviation from the empty coalition as the sum of all Shapley values, right? So that's really neat. It's infeasible to compute Shapley values for more than a small number of predictors, right? Exact Shapley values, which goes to your question, Emmett. And this is where Strummer and Kononenko propose an algorithm using the sampling-based approach of Castro et al. We develop a refined version of the algorithm and then extend it to estimate the contribution of individual predictors to portfolio performance. Now, in this literature, normally the Shapley value is shown in equivalent form, but just in terms of order permutations, where again, you're going to have the sum of all, of the sort of like the prediction with and without the particular predictor that you're having. And then you're just averaging across all of these marginal contributions, right? So the idea is to make a random draw M with replacement from pi p, which is the set of all order permutations. And again, you compute the marginal contribution, and then you keep on doing that. Now, the interesting thing about this is that it converges quite fast, right? So the person that essentially, and Strummer and Kononenko came with this algorithm, but the person that made Shapley values, very popular in computer science. So if you go to most packages now, they are essentially using, some sort of Shapley value computation to give you a marginal contribution, was Lumberg, right? And in their Python package, they are only doing this, they are only setting M to 10 or 20. So, this thing converges quite fast. So we were quite impressed by that. What you do is that you essentially use background data from the training sample to integrate out predictions not in the coalition. So you're using the same model, but you're you're predicting, with, for the different coalitions, but you're not retraining the model. You're basically just integrating out predictors not in the coalition. This you do that because you want to remain true to the model, right? Yeah, so you can estimate the Shapley value again just as essentially the average of all of these marginal contributions, where m is the number of draws. It becomes 2m because we're using antithetic samples, so that increases efficiency. And again, local accuracy holds, so you can decompose the prediction of the model in terms of deviation from the empty coalition, so the model with only a constant, as the sum of Shapley values for all the predictors in the model, right? Then, so how do we know how to decompose the predictions of the model? This is, sort of like the classical Shapley value in machine learning. And then we say, okay, how do we decompose portfolio performance? So if we start by considering an investor who decides to, on his or her allocation across n stocks for the next period, so we are standing at TJ end, and we want to essentially, so we're starting at TJ end, and +1, so we want to sort of like decide our allocation for today for the next period. So this allocation will essentially depend on the entire set of forecasts for the n stocks. And the expression for these for the weights of the portfolio is going to be given by this in our notation. And our methodology is general, so it applies to any strategy for mapping returns forecast to the portfolio weights, right? So you could use a classification model as we're doing, or you could use a regression model. And then the portfolio return essentially just ends up being the returns of all the stocks at period TJN +1. Multiplied by the portfolio weights, which your model is giving you, right? And again, here goes back a little bit to your question, Mehmet. I mean, why long short? This is just the empirical application that we chose, and sometimes you want to stay sort of close to what the literature does. But you could, use other strategies, right? As long as you're using a machine learning model to compute returns, and then from those returns to some sort of strategy. You can decompose, right? Any performance metric. You could also have, a strategy that only goes long, or a strategy that only, goes short, or whatever. It doesn't really matter. We're just following the, long-short classic strategy. Then we use the logic of Shapley values to decompose the portfolio return by modifying the algorithm. So again, you're essentially just wrapping the computation of the Shapley value around the portfolio return, but in a way that you retain all of the properties from Shapley value, right? So Shapley values are consistent estimators of the marginal contribution of the predictors, and there you will still keep local accuracy. We again use background data from the training sample so that we remain true to the model to integrate out all the predictors that are not in the coalition. And then you estimate the Shapley value contribution of predictor P to the portfolio return using the same idea, right? You just take the average of the marginal contributions. So when we decompose portfolio performance, we first need to decide on a baseline portfolio return, right? And then it is sensible to ask, if I had no information, so if I didn't have any predictors, how would I form a portfolio? And the most common answer would just to take the value weighted market portfolio, but you could also set it to 0, or I mean that would be, but that's essentially not investing. But you can choose whatever baseline portfolio you do, and then calculate the Shapley values in terms of deviation from that baseline portfolio, right? So again, local accuracy continues to hold. You will be able to decompose the contribution of predictor P to the return of that portfolio in terms of deviations from your baseline portfolio. And that is really neat, right? Because normally what you end up doing in these situations is that you choose, for example, the market portfolio, and then you want to see whether or not, using this model, you can actually beat the market, right? So to compute the SPPC, Yeah, because now we know how to decompose portfolio performance, but we don't know how to decompose metrics, right? Because again, your portfolio might be producing better returns than the market, but it might also be taking a lot more risk, right? So you want to compute portfolio metrics instead. And all of these metrics are local, so you can do it for each individual return that you have predicted. But when you move to portfolio performance, for example, Sharpe ratio, that can only be done, in a window, right? The same with alpha or, many other metrics. You cannot really do it for a single observation, but you need to have an evaluation period, right? So our sample of panel data spans T periods. Then we have an initial period, T subscript in, stands for in sample. And then we generate returns forecasts from, T subscript in plus n up until the n of our sample. So we essentially have the return. So our evaluation, the size of our evaluation window is D. And so this window that you're using can be rolling or expanding. In our case, we're using a rolling window, but because it performs better, but it doesn't really matter, right? You can do whatever you want, rolling, expanding. And we index the set of training windows by W, right? And again, that one goes from 1 up until T, which is the size of the evaluation window. So again, what is it that you do to compute the contribution to the performance metric of your choosing, which we denote by M? You wrap around the function, but you do it in a way that you keep on having all of the nice properties, right? Local accuracy and consistency. And again, what you end up with this, form, with this formula for the SPPC for predictor P. And importantly, again, local accuracy continues to hold. So you will be able to decompose the contribution of that particular predictor for that particular metric in terms of deviations from the base portfolio, right? Yeah. So essentially, the sum of SPPCP's estimates provide an exact decomposition of the portfolio performance relative to the baseline portfolio. Again, I want to emphasize what I said in the introduction. This measure is model agnostic, so it applies to any prediction model, and it accommodates any rule for mapping returns forecasts to portfolio weights. So again, sort of like reinstating your comment, we can do other strategies, and we can decompose those other strategies that not necessarily do the long short.
Yeah, I mean, maybe like one possibility will be like 90 to 10, 95 to 5, something like that, rather than 80 to 20.
Yeah. So I mean, 80 to 20 is like sort of like the standard in the literature,
Yeah.
but it's possible that other ways of doing it are better. Our empirical application is very strong. I am certain that there are better applications out there, but again, it wasn't really the purpose of the. So we wanted a strong empirical application because in essence, when you look at this Chen and Zimmerman data, they are very, it's a really nice data set, right? And they are looking at all of these possible sort of like firm characteristics, but you could also think that they are mapping the whole universe of possible anomalies. And then if you have a really strong model, and then you're constructing this sort of like risk neutral long short portfolio, then you're essentially answering the question of what is it that is driving expected returns, right? And I actually presented this paper in Stockholm, or was it around 10 days ago, and Chen was there, and he said, this is probably the way you want to frame your empirical application, right? You're decomposing expected returns. A little bit of an ambitious way of framing it, but that's what he thought, and maybe we should rewrite that part. But again, this is just we take the data from the open source asset pricing website of Chen and Zimmerman. We transform all characteristics cross-sectionally to ranks, and this is sort of like becoming the standard. There are several reasons to do that. Our sets of returns comes from the CRSP, and this is essentially the whole market of firms, well, at least those that have a value of the CSP at the end of the previous month, and there is no missing value for common equity. The total sample spans 744 months, starting in the 1960 and ending in December 2021. Then we have this group of predictors. Chen and Zimmerman provide a grouping. We decompose it a little bit more. Again, I presented this, as I said, 10 days, and he was really interested. Chen was really interested in how we had decomposed it, because we deviate a little bit from what they do, because some of the groups that they use in their paper are fairly large, and we wanted to decompose those into smaller groups. Also, groups of approximately equal size, because if you put 90 predictors in one group and then the rest into smaller groups, then that very large group is obviously going to have a very large marginal contribution, almost by construction, right? Because you're putting so much information into it, and it becomes also less clear what you're capturing, because you're grouping a lot of characteristics. So these are the groups that we consider. Again, we're grouping due to interpretability, easier interpretability, and due to computational concerns. But in principle, you can do it for each of the 207 predictors in the dataset. Construct the zero investment long-short portfolio. We have an initial sample window of 156 months and a very long out-of-sample period starting in 1973, and we're doing a rolling window. We retrain the prediction model each month as additional data becomes available, and we consider both regression and classification models. The classification models do much better. Again, that was something that... So on the one hand, it's not surprising, because this is a classification problem. So using a classification loss function should do better. We just didn't expect to do it that much better. I mean, you're getting a lot of extra performance by treating this as a classification problem instead of a regression problem. Again, we have 5 classes. We could consider other classes, 10 deciles, but we keep to sort of like a standard quintile. We drop stocks with a market cap below the 90-20 percentile. So to take care, this is standard, but we don't want our results to be driven by illiquid stocks. We evaluate the long and short legs, and then we scale the weights of the long short leg to some, between to some to 1 or -1, right? Depending on the long leg to 1 and the short leg to -1. We use XGBoost as mentioned. And importantly, another thing that I think it's new to the literature, but that works pretty well, is that we tune the hyperparameters each month using a work forward procedure that respects the time series dimension of the data, right? But we select the vector of hyperparameters by focusing on the Sharpe ratio instead of minimizing the log loss, which would be the typical procedure, and that seems to give us. And again, we could also base it on alpha or other performance metrics, but we thought Sharpe is sort of like the most popular performance metric, I would say. So it made sense to basically select hyperparameters based on that. So what is the performance of the portfolio? Again, we have the market as our benchmark, and we have the XGBoost. Very impressive results, as you can see. So you have an annualized mean return of 22.6, lower volatility than the market, which essentially gives you a Sharpe ratio that is significantly larger than the market. Annualized alpha of the from a French 6-factor model and the Q5 factor model of 19.4 and approximately 16%. So very large, and they are statistically significant at the 1%.
Can I ask another question?
Mm-hmm.
Did you guys also check like a sub periods like 2008 and 9 recession period?
Yeah, we'll get to that.
Perfect, thank you.
So this is essentially, again, remember that the Shapley values are, they have this local accuracy, so they, you essentially decompose it. So we start, the top row is essentially the baseline, and then you have, annualized mean, volatility, the Sharpe ratio, and then the alpha, which is essentially 0 for the portfolio. And then at the bottom, we essentially have the results of our XGBoost based model, right? And then you can essentially see the contributions of each of the groups of predictors to this. So for example, here we see that risk, earnings, seasonal momentum, and momentum have the largest contributions. For volatility, negative contributions are good, right? Essentially, you want to decrease volatility. And again, you have that, for example, seasonal momentum, valuation ratio, valuation, and volume are the groups, the predictors that have the largest contribution to decreasing. Sharp ratio sort of like, it aligns very well with what we saw with the, returns, and the same with alpha. So in general, you have that risk, earnings, and, the two types of momentum having the largest contribution over the whole sample period, right? Then one nice thing about alpha is that, well, you can do this really nice waterfall chart, but you can also decompose the alpha not only in terms of the contribution of each predictor, but also the contribution of each predictor and whether or not it was the short or the long leg of the portfolio, right? And this was what I was mentioning before, that, well, it seems as if both the short and long leg contribute equally to alpha, maybe a slightly larger contribution from the long leg, which is dark green. The short leg is light green. But for example, when you look at risk, which is the sort of like the most important set of predictors in terms of sort of like positive contribution to alpha, you can see that it's actually the short leg of the portfolio that is having the largest contribution. The same for momentum. And you can also see that there are some predictors for which the long leg has a positive contribution, but the short leg is actually decremental. And the total effect, for example, of volume is negative, right? So actually, if you were to remove that predictor, you will end up with a higher Sharpe ratio, which we found quite interesting. The picture for the Q5 alpha, similar, but again, we have less strong. Slightly lower results. Now, one thing that is really interesting also is the fact that, what we call risk here, I guess you could sort of, you can look at the list, but I guess you could sort of like map it or, think as, different sorts of, beta, right? So the market risk, it's also a little bit of idiosyncratic risk. And this is a factor that is already controlled for in the Fama-French six-factor model. The same with momentum, right? The Fama-French six-factor model includes momentum. Yet we find that predictors, that in the momentum group are contributing positively to alpha. This essentially tells us that what the XGBoost model is doing with this sets of characteristics goes beyond, the simple, long-short way of constructing these factors, right? And sorting. Perhaps it's non-linearities. Perhaps it's just the fact that, momentum, in essence, it's a relatively large group of predictors, but it does tell you that, the classical way of linearly controlling for these things is not enough, right? Because otherwise you will not find that these predictors are contributing positively to alpha in a model that supposedly already controls for that, right? So we find that quite interesting. Here I guess, an image is worth more than, 1,000 words. Here you can see the cumulative log return of the XGBoost portfolio versus the market. As you can see, most of the gains come from the period prior to 2004. There is a couple of papers in RFS that talk a lot about this break, and the idea is maybe that the information dissemination became so just market essentially became more efficient because information was more accessible. I also believe that in general, Excel, the internet, people just started, following firms, and it became harder. And again, you will not be able to achieve these returns. First of all, XGBoost did not exist, right? Prior to, what was it? It was invented in 2016. It was much harder. You couldn't, theoretically, you could construct the Chen-Zimmerman data set, but it would be very, very cumbersome, right? But it does tell you the fact that, well, prior to this period, you would have, achieved, incredible returns. Have you, been able to, have an XGBoost model and these sets of characteristics, right? Here we're doing the composition of the two subsamples. We choose these subsamples primarily because there is such a structural break, and because other papers sort of like find the same break. Again, the results prior to 2003, impressive. After 2003, I mean, we're still beating the market, right? Well, in terms of annualized return, only by a little. I think we're primarily in terms of our Sharpe ratio being larger, or the model Sharpe ratio being larger than the market, probably comes from basically a decrease in volatility. So you have a significant effect on risk. The two alphas are still large, I would say, and statistically significant. And again, if we look at the two subsamples, so we're looking at the Sharpe ratio. Notice that in contrast to the prior figure where I was showing alpha, and the alpha for the baseline is 0, right? Alpha for the market portfolio is 0. Here we're comparing the Sharpe ratio on the first subsample, and the Sharpe ratio for the market is obviously positive, right? And it was 0.3 in this case. The largest marginal contribution of a predictor is again risk, with a very large positive contribution in this first subsample of 0.6. So just that sets of predictors by themselves have twice as much marginal contribution as the total Sharpe ratio of the market, which we think is quite impressive. There's a couple of predictors, ownership and sales, that had essentially a negative contribution, but otherwise all the other sort of like anomalies in the data set seem to have a positive contribution. When we move to the second subsample, the figure becomes sort of like more nuanced or complex, right? You still have a risk and earnings having a positive effect, but for example, momentum is essentially having a negative effect, right? And this perhaps relates a little bit to momentum crash, and as we will see later how it looks across time. And then there are many more predictors, particular reversal having a large negative effect on Sharpe ratio. Again, we do still beat the market, but by a much lower market margin. Here, what we do is that we look at the Sharpe ratio contributions for a 60-month rolling window. In the paper, we have many more of these figures, in case you're interested. What we're doing here is that we're normalizing such that, 1 essentially means, that this is the largest contribution by that period. And we do that because, these things are essentially changing over time. So we needed to normalize. But one interesting fact is that, for example, we see this momentum crash that is, reported in the literature, and it sort of matches what other papers find. So, momentum being an important and significant positive factor, and then suddenly it just disappears. Risk having a long period. Where the shaded areas here are recessions, and you can clearly see that some of the factors have different effects during recessions. For example, profitability, it goes from negative to a really positive effect. You also see that some of these predictors are generally having, a detrimental, although small effect. So, for example, sales. And I guess, you can tell a lot of stories about these figures, right? And we have a similar figure for alpha, for the Kalmar ratios, for other performance metrics. So in conclusion, the information in the underlying predictors in a fitted ML model is the ultimate source of return predictability, right? And its associated economic value. So the existing literature does not provide for a general procedure of decomposing economic value. So here I must say that usually what people do in the literature is that they compute so if they want to analyze, the marginal effect, they just compute the returns with and without the predictor that you're interested in. And that is, the computer science literature is very critical of that approach. First of all, it will not have all of these nice properties that Shapley values have, so it will not be additive. And yeah, what ends up happening is that you essentially don't really have the marginal effect because you're having a lot of correlated predictors, right? So you end up having something that does not really sum to the total marginal effect. And there are many other, reasons why that is not. We will add that in a future version of the paper as a benchmark because, intuitively they are going to be similar, but obviously Shapley values are better, right? So essentially what we're doing is that we're filling this gap in the literature, coming up with a more advanced method and proper method of measuring these marginal effects that is not simply just removing that predictor. And again, which again gives you a different model, right? You're not really looking at that model because suddenly you have removed a set of predictors or a predictor. The measure that we come, the SPPC, is very flexible and powerful, right? Because it essentially allows you to understand the sources of economic value produced by a model, right? We illustrate the SPPC by an empirical example using 207 characteristics of German-Zimmermann. This portfolio generates sizable Sharpe ratio as well as large alphas. We organize the predictors into 20 groups based on economic concepts. Over the full period, we find that risk earnings, seasonal momentum, and momentum made the largest positive contribution, while sales and ownership generally make negative contribution. Earnings, seasonal momentum, and investment make also positive, relatively sizable contribution on a consistent basis over time. I guess I finished exactly 16:50. I don't know if you have any questions.
Thank you. Actually, I have a question. If the panel, if no one asks a question. So I think this momentum issue is a big deal because in the last, I mean, when in your graphs, it's very clear that in the last 6-7 years, momentum has a negative effect. It's very clear. And like, I remember like looking at the returns from these machine learning robotic funds in US, in hedge fund, like 2022, they were having huge negative returns. And I'm guessing since ML algorithms are following mostly momentum-based, these trading platforms are momentum-based, they're like losing money in 2022. I don't know the other years, but so it's kind of like clear from this picture too.
Yeah, and it matches also, what people, in the literature have been finding regarding momentum, right? I mean, there was a structural break, around this period where, it just flipped and I mean, our sample ends in 2021. What you're telling me is that, it keeps on doing bad now, right?
Same. 2022 is the same as, I think the big difference is like in 2022, there's a big drop in the valuations in the stock market. So maybe even it will be worse, I think, the momentum case. This is my expectation. But yeah, it's very good that we learn a lot from these pictures. Like you learn like what contributes in what way and in which time period, which is also very important.
Yeah, and like again, I presented to Chen 10 days ago, and I was really interested in his opinion, right? But he told me, I didn't know what to expect. I mean, I had some priors, but he was also interested because I mean, he asked me, look, he created this data set, right? Or him and some Zimmermann. But yeah. On the other hand, I mean, we do find a lot of things that are consistent, with prior literature, and we think that is interesting. And again, when you think about the largest, players, these are, like really popular sort of like factors or anomalies, right? So we just end up basically confirming, what we already knew.
Yeah.
Perfect.
Thank you. I asked so many questions. If somebody wants to ask, please just shut me up.
I guess it's a small audience today.
Yeah. Any questions? No. So thank you so much, Christian.
Yep, no problem. Thank you for the opportunity.
I really enjoyed it.
Thank you. Bye.
Bye.
Bye, Christian. Thank you.